Yeah, guys, in general, we all start entrepreneurship because we see a problem that we're trying to solve, or we see something that kind of just grinds our gears, and we say, okay, I can do it better, and I want to do it my way. I want to show everybody that, I can also solve this problem and add my own unique twist to it. And what gets us started as entrepreneurs isn't what gets us to the finish line, which is ultimately something that is a business that pays yourself. Maybe it's something that lets you go for an exit. Maybe it's something that can ultimately finance your next, lifestyle choice or whatever you'd like to do in the future, right? So when we start the business, we're passionate about the product, we're passionate about the problem. And then over time, as we stay in the business, we realize, okay, well, there's certain KPIs that I have to be aware of, or there's certain things that you have to do in terms of sales to keep the company afloat. And a lot of that hopes and dreams kind of approach that started the business kind of slowly starts to die out. And I found that 82% of businesses fail not because of a inability to get customers or an inability to get clients. They actually fail within 5 years because they don't have strong back-end infrastructure, they don't have the right financial systems, and they have no way to make the right decisions when it comes to reinvesting the money that comes in. And this was one of the things that I saw time and time again as a risk manager, and also as somebody who now runs a few businesses, and also I'm an investor, and I see this across the board. So I love sharing this message, and I love sharing this system with people and showing them how they can improve their business just by implementing these quick techniques. You can coordinate it with your bookkeeper. And if you don't have one, we have people that can help you as well to do it. But we've been doing it for all of our companies, and it's been incredible to see how quickly and how simply we can make better decisions faster just by looking at our financial systems this way. So I'm only going to give you a small piece of the overall system because I don't want to put too much on you during this workshop. I'd rather you really wrap your head around the core principles. And then obviously everyone's business is complicated as well. So I think it's good to do it in this framework. I've seen a lot of success with people doing it this way. So I'm just going to share my screen real quick and kind of show you all what we're talking about. So if you've ever drawn up a business plan and said, okay, this is too hard, it's never going to work, maybe you've given up on it and then you've gone to the next thing, or maybe you've applied for a loan and you've gotten a no for funding, or you've had a disagreement with your business partner, this is kind of the right step for you to maybe, take a step back and say, okay, let me look at this detached from the actual business, because we're all so busy working in our businesses every day. We don't have a chance to look from a third party view or from a bird's eye view and say, okay, how do I actually move the needle? How do I unlock the value that's in the business? So this isn't something about budgeting, forecasting, or tax planning. It's something you can literally do right after this call. You'll get more profitable. You'll have a lot of aha moments pop up in your head, and you'll say, okay, this is a game changer. Now you can look at your business kind of like a video game. You're going to immediately get more ideas on, who you should hire, who you should, unfortunately fire maybe. Within the next 30 minutes. So why should you listen to me? I've spent the past 8 years managing risk, investing money. I've shorted basically every single market crash since 2018. I've scaled several businesses past that $1 million revenue mark as an operator, advisor, strategic partner. I was handling over $3 billion as a private market maker for a private investor. And I've analyzed thousands of businesses, if not tens of thousands of businesses. And today I operate a portfolio of 8 companies with about 300 employees around the world, all involved in SaaS and service businesses. And if there's one thing that I could take away from almost a decade as a quantitative trader, is that every single business, every single strategy has nailed the following three KPIs really well. It's all about your win rate percentage, your risk reward, and the frequency that you're allowed to attract those highly optimal bets, right? And every business depends on these three ideas. It doesn't matter what product or service you're selling, the market will dictate, it'll constrain your ability to be successful based on those three core principles. So, this is a question that I typically ask all my entrepreneurs. I say, okay, well, if you want to make $1 million a year in profit and your industry average benchmark for net operating income is 10%, how much do you think you have to invest to make that profit? You have to invest $9 million because you're expecting to make 10 million from that $9 million, right? So there's no risk without reward, right? And there's no reward without risk. Typically, we have to put our money into the business before we can see a return. And depending on how well you can handle the iteration cycles, it can be faster or slower. For companies generating a quarter to half a million in revenue, we can typically see paybacks on our investment decisions in 3 to 4 weeks. If you're an enterprise, it could be quarters, if not years, right? So everything we're doing is optimizing for how much do we have to spend and how quickly can we liquidate that spend and make a return and reinvest our free cash flow. So it's all about keeping it simple, right? The KISS method, keep it simple, stupid. When we're going through so many companies and all of our client companies, we need systems to quickly analyze the health of the business and make sure things are on the right track. And just by looking at this system and seeing things differently, it's going to change your life. So what I'm going to accomplish in the next 15 minutes will completely reframe how you want to look at your financials. This isn't something for tax advice. It's not something for investors to see. This is for you to get a better grip on your financial decision making as you go about it on a month to month or even week to week basis, depending on the cadence of your business. This is something your accountant or bookkeeper will typically show you, and it's something I don't really agree with because you can't really do much of it. If you've ever had a conversation with your bookkeeper or your accountant and you felt like you're just missing that extra sauce, you're missing some extra juice, maybe their opinion on your business, or maybe something that you can do based on the numbers to help you get that extra squeeze in. I know Q4 right now is incredibly busy for us. We have almost every single CEO's reaching out to us, talking to us about strategy and where to invest their money, how do they should they, handle their financing and stuff like that. P&L statements, profit and loss statements that look like this don't get us anywhere because they're GAAP compliant, generally accepted accounting principles. They're meant for formal, IRS audits, investors, things that are not really going to help you drive the needle in your business unless you have somebody analyzing this every single day. So when it comes to actually growing your business or spotting a red flag, that statement isn't really going to help you. And typically, when we want to get a grip on the business or we want to move the needle, we just need to redefine how we look at that P&L statement. And typically, we do this by setting up a wants and needs list for the business owner first. So, what does the business actually need versus what does it want? And then we ask the founder or the entrepreneur or the CEO or maybe the board of investors, depending on who we're talking to, what do you guys actually want and what do you guys actually need? And once we can identify all of these things, it becomes a lot clearer to understand where we need to move the needle, where we need to actually drive the business, what is the biggest constraint in the business, right? And then after that, we move to a SWOT analysis. And the SWOT analysis is kind of just a general way for us to figure out where our strengths and weaknesses lie. It can be incredibly simple or it can be incredibly complicated. It just depends on where the business is at. And there are industry catalysts, key operators, and other factors that will contribute to our successes and failures. So when it comes to crafting our P&L statement from the ground up, we want to plan our future business ideas ahead of time. So if we're going to do a new product launch, or maybe we're going to make investments into AI now, so we're going to add that to our R&D line item, or whatever it may be, when we work with our clients or with our current portfolio companies to define the P&L and create budgets and forecasts and stuff like that, we're immediately asking ourselves questions like unit economics. What does our revenue mix look like? How about our customer concentration? And these questions build a P&L where, as the CEO, you can drink your margaritas on the beach, look at a snapshot in under 2 seconds, and you know immediately what the health of the business is just from that. So let's just do a quick example, and then I want to show you a little bit of probability to help you understand why those three ratios are so important when it comes to your business. So let's say we have three different offerings. We can have revenue with a product A, service B. That's great. So we've broken down our revenue mix into these products and services. That's pretty cool. Most accountants will just lump all of your revenue mix into just sales, and you won't have any understanding of what's going on unless you ask them to do more work or you do it internally on your end. But typically, we see that most people just lump in everything into sales. So there's no actual way of understanding the revenue mix. That's one of the first things you have to do. The next thing we need to understand is what are our non-labor direct costs? So just to keep the lights on, what are the direct costs in the business that are non-negotiable, right? So maybe it could be software, it could be inventory. Typically, inventory goes a little bit further down in our P&L statements, right? Right now, we're saying, what does our inventory look like for product A? What about XYZ? How about our website, CRM, anything? The whole point of this exercise is to understand what are our non-negotiable fixed costs that are just part of running the business on the day-to-day. So once we figure that out, we get to something called a gross margin figure. Revenue minus non-labor direct costs is gross margin. This is like, all right, this is like the business's real revenue figure. It's just a non-negotiable cost, and this is how we can estimate, okay, well, what is our next hiring, firing, building in a new tech stack look like? Right after we get our gross margin figure, we're looking at our direct labor costs. So the same thing. It's that key employee in the company. It's that key person for fulfillment. These are your fixed labor costs that you just can't get rid of. Now we're kind of building out this P&L statement, right? You see, we have revenue, we have direct costs, gross margin, direct labor costs. Once we subtract our gross margin and our direct labor costs, we get the real financial KPI that we care about, and that's our contribution margin. This is the most important figure in our business. It'll dictate how fast we can grow, because win rate times risk reward times frequency equals good business, right? Our contribution margin is our win rate. Risk reward is how we make decisions as a percentage of our contribution margin. So when I invest in marketing, that's risk reward, right? But our win rate is actually the percentage that we win. So now we have revenue, direct cost of goods sold, gross margin, direct labor costs, and contribution margin. We've defined our business model. Like, this is your business model. The way you want to market this business model is a separate topic, right? But at this point, we have a core thing that we know works, right? We're going to get something positive out of it at the end of the day. This is going to be the Ferrari that takes you from Monaco to Rome, okay? But cars need fuel. And the fuel for every business is marketing and sales. That is, and I hope you can see now how we're dividing this up, right? We're building out, okay, this is profitable. This business model is profitable. Now we need fuel that's cost effective. Without marketing and sales, you don't have a business. There's no way for you to attract clients. There's no way for you to make more money. There's no way for you to make sales. You need marketing and sales. And this is where the investing portion comes into things. This is where we have to understand, okay, how much marketing do I have to do to get the return from the contribution margin? That's the whole name of the game. And in our marketing department, we talk a lot about, okay, creative software, paid ads, affiliate commissions, trade shows, SEO. What's the best strategy, right? But we also organize our P&L statement to reflect which strategy we're spending money on. And we're also considering our direct costs of marketing as well. So now we're going a layer deeper in this sub account, and we're saying, okay, I need to invest more into this type of software. Does that fit my direct cost of marketing budget? Right. So when we start budgeting per business unit or per department, we have these things. So now we have revenue, direct cost of goods, gross margin, direct labor costs, contribution margin, marketing. We'll do the same thing for sales. Salespeople need dialers, right? There's some new stuff coming out about dialers, but let's just say they need dialers or they need some type of CRM or some type of software, right? And then we have our direct labor costs for our sales team, right? Setters, closers, BDRs, SDRs, you name it, account executives, blah, blah, blah. So here's an example of what it should look like now for your business. I pulled this from one of our companies. Immediately we can see they have and this is a QuickBooks thing. It says gross profit down here. It's a contribution margin thing here. When we started working with this client, we immediately, after reorganizing their books, saw, hey, you guys have a flawed business model. Let's correct the business model before we talk about the right marketing strategy. And with that one trick, the business owner is able to say, oh, wow, in this case, maybe we need to spend less on contract labor, right? Or maybe it's part of the overall business model. Maybe they needed to make all these hires so that they could sustain a massive contract coming in. It's part of the story, right? But I'm going to leave you with a pretty neat trick that you can use once you've organized your profit and loss this way to help understand the performance of your team. If we take our contribution margin and divide it by the total cost of our sales team, that'll give us a number, and we want that number to be as high as possible. See, most people will do revenue by employee to figure out what is going on in their business or how successful their business is, and then they'll compare that to industry benchmarks of, let's say, like, oh, you need to be making 300 grand or 400 grand per employee or something like that, right? As an enterprise company, industry standards, et cetera, et cetera. Well, we can actually divide that against our contribution margin and say, okay, well, what is our contribution margin by the person in our team? Like, how much are they contributing to our actual business model? Can we make our business model leaner or more efficient if we had this person on the team or if we didn't? And these types of investing decision-making processes refine your business and ultimately make you more money. Because just by spotting mistakes in the core business model, you'll be a lot more confident to pull the trigger on more marketing because you know now your business model works. It's been proven financially. You've cleaned it up. And I have a spreadsheet right here, which you can copy, you can take, you can plug it in for your own business, and I'll put the link in for everybody if they want the copy. And in it, you can see by months and by quarters, and then for the total fiscal year, plug and play, what does contribution margin look like, right? So in this case, it's all explicitly laid out for you, and the doc also includes all of this. Before I finish and before I include this link, I want to show you why it's so powerful. So once again, remember we said that there are 3 KPIs that I care about. So let's say F is frequency or maybe volume. Then we have our contribution margin, which is our win rate percentage. And then we have risk reward. There's this idea in statistics called expected value. And expected value says that you have a profitable strategy if the expected value is greater than 0. And the way we calculate our expected value is we take the probability of winning. So let's say we have a 60% contribution margin. So probability of winning times the amount we're going to win. Please excuse my handwriting. Minus the probability of losing times the amount we're going to lose, right? But I'll give paid ads as an example. If I know that I only risk $1 on my advertising, and every time I do, I make $4 in revenue, which trickles down to 60 cents of each dollar, so $3.20, right? So 3.2. And I know that my win rate on it is, let's say, you could say your close rate statistics or something like that. So let's say you have a 30% close rate, right? So your close rate is 30% to make a sale times this figure. We're looking at roughly $1. I'm gonna estimate that this comes out to about $1, a third of 3.2, minus 1 minus 0.3 is 0.7, minus 0.7, right? 70 cents. Now I know that with whatever's working right now, I'm winning. I'm making money. So even though it's not as much as I'd like, I'm still making 30 cents on the dollar, and that's actually greater than zero. Let me just erase this right here. What's going on? So this 30 cents is greater than zero, which means I should keep doing my strategy. And then the question is, okay, well, we're profitable overall as a company. How do I maximize it and win more? That's really the question at that point. But these are one of the first things we do whenever we look at a new company or we're working with our CEOs and they're in a rut, and we say, okay, let's review what your expected value is, and let's review what your financial statements look like on the P&L side so we can just validate the business model and make sure it works.